Good. All right. Let's start this video off with one of my favorite reviews. Very important. We're going to rewind the clock back to 2006, okay? Because what happened in 2006, specifically the summer of 2006? Well, the summer of 2006 was when interest rates went flat. It was the top of the interest rate rising cycle, okay? What did the market do? Look at for yourself. Open your eyes. Look at the chart. What happened to the market when interest rates went flat in the summer of 2006, okay? Summer of 2006, rates are flat, market rising all the way into October of 2007. Yeah, that's a pretty long time. But what happened when interest rates started to come down? Well, that's exactly when the market came down. So, some interesting parallels from the 2006, 2007, 2008 interest rate cycle to now. Because where are we in the interest rate rising cycle right now? Well, there's some reason to believe that we are towards the end of the raising cycle, and we may be entering the flattening part of that cycle before interest rates come down once again. And you can see very clearly on this chart, the rate at which the rates are increasing has definitely started to roll over. And it's possible that at the May 3rd meeting, we may see the final interest rate increase for the cycle. No guarantees, obviously, but it is very possible because for the same reasons that interest rates had to flatten out in 2006, interest rates are flattening out for those same reasons. It's because there's a crisis on the horizon. That's why they're flattening out. That's why the stock market typically crashes when interest rates begin to fall. Rates are falling because there is a crisis on the horizon. And now that they've raised interest rates high enough, well, guess what? They can lower them just in time for the crisis. So that, I believe, could be what's playing out right now. Now, the Fed essentially has one more chance to say that they're doing their job in fighting inflation by raising interest rates. But the fact is, they now have significant pressure, more pressure than they've had in years, to no longer raise rates because of the pressure that the banks are under. So what is the pressure that the banks are under right now? Well, it's the value of their balance sheets. The value of the balance sheets of banks like large banks, not just regional banks. We're talking all the banks, right? We're talking the entire XLF. I mean, just look at the XLF. How many times have I talked about this? I did talk about last week how the XLF may be getting a short-term bounce, and we're going to talk about that in a minute. But let's just kind of look at the big picture for now. So this XLF representing JP Morgan, Wells Fargo, First Republic, Bank of America, all of these banks, we now know that they're holding bonds. Interest rates rising is decreasing the value of the bonds that these banks are holding, and that is putting a lot of pressure on those banks to service all of their customers, right? In the event that their customers, say, need to get a lot of capital, well, guess what? The banks aren't heavily capitalized at this moment because the value of their bonds is really low right now. So this is putting pressure on the Federal Reserve to now lower rates or no longer raise rates if they don't want a banking collapse. So then the question becomes, well, do they want a banking collapse? And it's like, maybe, right? Because a banking collapse could lay the groundwork for the central bank digital currencies. You know, it's just another sort of like crisis that leads to all kinds of austerity. We've seen this so many times. We saw this in September 11th, 2001. Crisis leads to austerity. We saw this in March 2020. Crisis leads to austerity. Now they're setting up a banking crisis leading to financial austerity. And I think that's their most important austerity measure. Like, they really care about controlling the financial world. So it's hard to say if the crisis is on purpose or it's not. All we know now is that the Fed has enough pressure on them politically and otherwise to no longer raise interest rates. But of course, it might be too late, just like in 2008. It's like just because they stop raising rates now doesn't mean the crisis isn't going to happen. But what I'm trying to draw your attention to here is the effect on the short-term trajectory of the markets when interest rates go flat. As we look back to 2007 and to 2008, we see the markets continue to rise. This makes sense because the cost of capital is cheaper. This theoretically stimulates the economy. People are more incentivized to spend because they don't need to spend as much money borrowing in order to spend, right? So this is why the market, of course, can rise if interest rates are flat, even if there is a crisis on the horizon. But I draw your attention back to 2007 and 2008 just to show you that even if the market does go to new all-time highs, well, that doesn't mean the crisis isn't literally right around the corner. And the fact is, when we start to see interest rates actually get cut, and that might happen at the end of 23, maybe into 24, maybe even sooner than that, that's when we need to be concerned that the crisis is right at our doorstep and the top of the market may very well be in, because the top of the market came just ever so slightly after rates got cut in 2007. So rates actually got officially cut in July 2007, and the market rose from July 2007 into October 2007, and that's when it peaked, October 2007. So you had a little bit more headroom. You basically had your final blow off top when the rates got cut, but there was that big crash very, very shortly after. So the idea is that rates getting cut, that's telling you that the Fed is preparing for the crisis that in some cases they caused. You know, in this current cycle that we're in, it does seem like the crisis that we will see in the banking system is a crisis caused by the Fed. Because think about what the Fed was telling banks to do back in March 2020. They were telling them to buy bonds. The forward guidance from the Fed was to buy bonds. But look what interest rates were doing in 2020. They were at zero. So you'd have to be a complete moron to listen to the Fed telling you to buy bonds when interest rates are at zero. You have no upside on those bonds because as soon as interest rates start to rise, your bonds are worthless. And they didn't have any value to begin with because they weren't yielding any interest. So that's kind of pointing in the direction of like, is this sort of like some kind of intentional thing? Because, you know, these bankers, these like big banks, they've been around the block. They've seen multiple cycles. They were around in 2007. They were around in 2001. They were around in 1994. They were around in 1987. Are you telling me that they didn't know what the consequences of buying zero interest rate bonds were, knowing that at some point the Fed was going to raise interest rates? I don't believe it for a second. I'm telling you that I have reason to speculate that a lot of what's going on right now in the banking system is intentional, because I don't believe that any of the bankers that are holding these bonds that are losing their value rapidly are ignorant of the way that bonds are priced based on interest rates. I don't believe that anyone is ignorant of that. So the fact is, it stands to reason that the Fed is maybe laying the groundwork, like sort of like a phoenix from the ashes sort of groundwork situation, for a new paradigm in banking that's going to be more centralized. So you're basically scaring people out of the peripheral banking system, herding them all into a central banking system, and then at that point, you're giving them no choice but to participate in the banking system as it is, which is going to exist on their terms, which is likely going to exist on top of a central bank digital currency system, which obviously leads to a lot of surveillance, a lot of austerity, essentially. That's where it comes down to. So that's kind of the big picture here, laying that out for you. Just reminding you where we are in the interest rate rising cycle and what that implies over the next 1 to 2 years, okay? So hopefully that point is made. But let's talk about the short term. Let's talk about bonds in the short term. Because if we look at the Fed funds rate here, we can clearly see that its velocity to the upside is decreasing, meaning that it probably won't go a lot higher, meaning that bonds in current existence may start catching a bounce in value. We've talked about this. The spot price of bonds will rise if interest rates go flat or begin to fall. And that's what I'm speculating here. I'm speculating that maybe by June or July, maybe by August, we will start to see interest rates get to a level where bonds are now increasing in value because interest rates are no longer rising. So let's look at the bond market, right? Bond market represented by the TLT. This is the ETF that represents the spot price of bonds. As interest rates go up, this ETF goes down. As interest rates go down, this ETF goes up. So what do we see right here in the short term? Well, we've talked about this last week. I'm just reminding you, and also looking at the follow through on this week. We were looking at this weekly candle in the last White Knuckle report, and I speculated that there might be some more upside momentum in the bond market, and that's exactly what we got. We got more upside, and we got slightly increased volume, and we have the highest weekly close for the bond market in terms of its spot value that we've seen in, let's count them, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, well, 17 and a whole lot more weekly candles, but in this range that we're in, it's been 17 weeks, and now the bond market is at its highest value it's been in 17 weeks with relation to this specific range. But, you know, you could go back all the way to September of 22, and that was the last weekly candle that actually closed anywhere near the value that we're at right now. So that's telling you that there is upward pressure on the bond market. This is telling you that certain individuals, those individuals having a whole lot of capital, are taking a large bet that the Fed is actually very close, if not already beginning to lower interest rates, or at least flatten. I don't need to say lower, but I'm saying lower because the rate at which these bonds are increasing, I mean, it's pretty rapid. The past 2 weeks, I mean, look at this trend all the way back from February 2023, right? It's kind of ripping pretty violently to the upside, right? The buyers are beating the sellers. And so that's showing you that the bond market is pricing in lower interest rates. The bond market is showing you the future. It's foreshadowing what the Fed is ultimately going to be forced to do. So in the event that this bond market continues to rise in value, what does that say for the XLF? Well, that tells you that the XLF is likely to increase in value as well. Now, remember, I'm talking about things on the relatively near term here because there is a crisis looming over the horizon. We'll know that that crisis is about to hit really hard when interest rates actually get cut. That hasn't happened yet. But what I'm saying is, in the short term, bonds are catching a bid. That means that banks will catch a bid, and they've already fallen a whole lot. I've talked about the fact that this seems like a reasonable bottom. If you zoom in, look on the daily chart of the XLF, you can clearly see that this chart has found support at the 200-week moving average. And it's no surprise, right? Everyone's thinking doomsday crisis nightmares. That's typically when markets find a bottom before catching a bid. So if we look at the XLF right now, it's like, makes a lot of sense that there might be a bounce coming in here, and that would obviously be positive for all the markets, right? If the bank sector is doing well, other markets can outperform, no doubt about it, because I don't think the banking sector is going to be the leader here. I'm just saying that it's likely to catch a bounce that would be positive support for the S&P 500. Let's look at the S&P 500 really quickly here. What do we see here? Remember, we did have a shortened week this week, so pretty positive week, though, considering that it was a shortened week with minimal volume. We closed essentially at the top of the range, and we're still way above that trend line here. And I don't think it's crazy to think that the upside here is not completely over. Now, let's corroborate that with the good old DXY here, because that's telling another interesting story. Lots of news about the world reserve currency right now. Lots of news. And what's interesting here, remember, I'm looking at the weekly chart here. Look where this weekly candle closed. Below this trend line. This trend line that I've drawn, I drew this many weeks ago. This is a trend line that's very much respected right now. And I believe that if the DXY can't close above this trend line like it didn't this week, I don't know that it can next week. I do think that the next target for the DXY is all the way down here at the inverse 702. That is a major fall for the DXY. That would be a capitulation. And then you would have to expect a major bounce. But let's just say the next stop for the DXY is down here in the inverse 702, like literally falling 5 basis points in the DXY. Do you understand what that will do for cryptocurrency? Do you understand what that will do for the S&P 500, what that will do to gold and silver? They will literally go absolutely freaking psycho. They will move to the upside with insane aggression. And I do think something like that is possible, especially more in the crypto, gold, and silver sectors, because I think this is just one of those situations where investors are looking for that safe haven. And then the inverse ironic understanding is that the safe haven is no longer the world reserve currency. It's potentially cryptocurrency or gold and silver. And that's nothing new, right? Gold and silver have always been a safe haven when the dollar is in turmoil. It's not crazy to think that crypto could eventually fit in that same category of safe haven when the dollar is in turmoil. Now, I don't believe the dollar is in like existential permanent turmoil, but I do believe it's possible. We've seen the macro high for the dollar for years. I don't think it's going to go to new all-time highs anytime soon. I think it's more likely that you got to play out these inverse Fibonacci targets. And once we get down there, we can decide, okay, do we think this is a bottom, or do you think the dollar is literally about to actually have a serious crisis? I don't think it's about to have a serious crisis. I think you're coming into a major bottoming process for the dollar, and that's why you have so much panic and fear about the dollar losing its world reserve currency status. Remember, all that panic and fear points to a bottoming process. You get panic and fear when you're in a bottoming process. So I think the same thing applies to the dollar here. I just think the target is still a little ways below where we are right now. And so if we are going to be heading down to that inverse 702 target, well, then guess what? That means that we should be expecting upside in the broader markets, gold, silver, crypto, and equities, all of them. And that's all corroborated by the fact that the banks are probably not in as big of immediate danger as many people would think. Now, in terms of macro danger, yeah, they're in serious macro danger. But short term, like 3 to 4 months, I don't really think that. I think the banks are about to get some relief here, and the bond market is telling us that the value of the balance sheet of the banks is likely to increase if we continue to see follow through in the TLT, and the TLT is showing us that large money is piling in to bonds. That is a positive sign for banks, and it's a positive sign for the broader market, because if banks are supported and they're going to catch a bounce, even if it's a small bounce, well, then that allows for other sectors of the equity market and, of course, the crypto market to move to the upside. So, major thesis point of this video here is that in the short term, I do expect to see some pretty significant upside here. Okay, so let's just isolate Bitcoin for a second here on the daily chart, because I think what it's doing right now is quite interesting. Consolidating at the 236. What have I said about consolidation? I've said consolidation is often what happens before a larger move in the same direction occurs, right? So you're consolidating after you've been in a strong uptrend since December 2022. Well, technically you bottom in November 2022, but you have been in an upward trajectory since November 2022. You're now consolidating right on the 236 Fibonacci. What do you think is next here? Especially what I just said with the DXY. What do you think is next? I think this thing is probably about to poke through the 236. Maybe at that point, we see some more downward pressure, some scary stuff go on, and then Bitcoin gets pushed back down, because I don't think the next move for Bitcoin is going to be like a straight shot all the way to the 702, like happy altcoin season. I think there's going to be some serious volatility in here. I think a lot of that volatility is going to be driven by a lot of fear-based narratives just about the financial system in general, and people being very cautious about their money, and a lot of people still believing that crypto is a risk-on asset class. And it may very well be. The jury's still out on that one. But the point is, I think there's going to be a lot of volatility in the near term, lots of buying opportunities, because just like here, just like we saw in February 2023, we saw this nasty sell-off on Bitcoin, retest an important trend line, and then what happened? Shot up like a rocket off that. That's the kind of volatility I'm looking for and sort of expecting to see over the next few months. I think the rest of April is going to be very, very interesting. And if I were to guess and just completely speculate, not that I make trades based on my own personal speculation, but if I were to speculate, I would say that the markets are likely to move upwards into the May Federal Reserve meeting. So you have basically the rest of April where markets are theoretically free to move to the upside, because we're not going to be hearing from the Fed until May 3rd. Now, the Fed is very likely to at least try to pour cold water on whatever rally we end up seeing in the rest of April into the beginning of May, because, they want to be tough and they want to fight inflation and all this kind of stuff. So they'll fire that 25 basis point rate hike, and they'll use likely some very strong language to potentially, like I said, pour cold water on whatever rally we see. But ultimately, the uptrend is potentially begun, and it's potentially been going since, November 2022, at least in Bitcoin. And then in the broader stock market, like S&P 500, that uptrend has been going on since October of 2022, right? And so if this uptrend were to continue, the next logical point that it would have to go above in order to actually stay in uptrend would be the previous high from January 2023. So that would be S&P 500 having to exceed about $418. So if that happens and the S&P does make a higher high here, well, that really solidifies this uptrend. And at that point, you would really have to consider that the bear market low came in October 2022. Right now, we're kind of in that no man's land situation where it's just like, oh, well, if it doesn't make another all-time high, right now we're in that no man's land situation where if the market doesn't continue higher, well, then that means that it didn't make a higher high, and then it's harder to say that we're in an uptrend. But because of everything I just said regarding interest rates and bonds and what's going on with banks right now, I think that provides a window for the market to set that slightly higher high and really solidify that uptrend. So that's kind of what I expect to see in April. I expect to see another couple of weeks of serious upside momentum, because I think there is reason to believe that the bear market low is in fact in from October 22. And if I'm wrong, good thing I'm hedged, and you guys got to be hedged. You guys got to be smart. You got to understand risk management. Risk management is basically hedging. How creative can you hedge? That's really the name of the game, because everything I'm talking about is pure 100% speculation. I don't have a crystal ball. I don't know the future. I just know how to hedge. So that's what I got for you guys.